Hello, my name is Kenneth Lomas and I'll be presenting Exploring Narrative Economics, an agent-based modeling platform that integrates automated traders with opinion dynamics, on behalf of Dave, Cliff, and myself. The aim of this project was to integrate two hitherto independent efforts in modeling human behavior, zero-intelligence traders and opinion dynamics, the purpose of which would be to provide a new tool for simulating narrative-driven agent-based modeling. Recent works by Robert Shiller have outlined the underestimated importance of narratives in economics. We want our Opinionated Traders simulation tool to complement Shiller's work as a testbed for new narrative economics models. This project combines a lot of different ideas. I'm going to start with an overview of opinion dynamics models, then for each existing trader model that we build upon, I will briefly explain how they work and then how our opinionated versions of them work respectively, and I'll finish off with some details about the context of our results. Just in case you haven't heard of opinion dynamics modeling, I'm going to explain 4 different types of opinion dynamics models chronologically. The earliest opinion dynamics model is the Groot model, a conference of experts where different opinions on a subject is convened. The experts decide on a format of structured debate where each expert has a turn to express their opinion, taking the form of a real number, and at the end every expert updates their own individual opinion using a fixed weight. The experts continue to take turns sharing their opinions until a consensus is reached. In his 1974 paper, de Groot proves mathematically that the experts will reach consensus, given positive weights. In the bounded confidence model, every agent in the population holds an opinion value between -1 and 1. When two agents interact, if their opinion values are closer than the deviation threshold delta, then they update their opinions. The update rule is shown in this slide, where xi and xj are the opinions of experts I and j respectively, and w is the confidence factor between the two experts. Generally, in a symmetric bounded confidence model, the population converges into regular intervals the size of the deviation threshold. The confidence factor between the experts then affects how quickly they converge. The relative agreement model sought to reach more human-like convergences not in regular intervals, such as bipolar and single extreme convergences. It does this by adding uncertainties to the experts that are used to calculate how much experts agree. As shown in the diagram, the opinions xi and xj are points in the middle of their uncertainty ranges. For agent I, xi would be the opinion and ui would be the uncertainty, so the uncertainty range would go from xi minus ui to xi plus ui. In the grey box, the calculations for this are as follows. Hij is the overlap between the uncertainty ranges. Next, the relative agreement Raij is calculated by the size of the overlap proportional to the size of the uncertainty. Finally, if the overlap Hij exceeds the uncertainty ui, then update by a factor of the relative agreement multiplied by the weighting mu. That determines how quickly the population reaches convergence, just like the bounded confidence model. Here are some results that use the relative agreement model. It has been used in the past to postulate how small groups of extremists, for example on social media platforms, can skew the population's opinions into single extreme or bipolar convergences, especially in populations with high levels of uncertainty. However, the relative agreement model fails to capture an important part of sociology: reactance. Reactance is a reaction to pressure or persuasion that leads to the strengthening or adoption of a contrary belief. In the relative disagreement model, using the idea of reactance, agents that disagree move further away from each other. Mirroring the relative agreement model, the relative disagreement agents disagree proportionally to how much their uncertainties don't overlap. Additionally, there is a new parameter lambda that represents the probability of them updating their opinions. As the relative disagreement uses agreement and disagreement, the population converges much quicker. The lambda parameter is required to produce more realistic results. Here we see examples with lambda is 1/2 and lambda is 1. Convergence is clearly much quicker where lambda is 1. The relative disagreement model adds very important behaviors and manages to produce the same types of convergence as the relative agreement model, without having to initialize with a very large population of very extreme agents. Now that opinion dynamics models are out of the way, I'll now move on to how we define our opinionated traders. Firstly, opinionated zero intelligence constrained based on the zero intelligence constrained trader model, and secondly, opinionated near zero intelligence based on the near zero intelligence trader model. We are using the Bristol Stock Exchange project to simulate our results. This is a Python program available on GitHub that simulates a stock exchange with buyers, sellers, and a tradable asset. Bid and ask prices are submitted to the exchange and published on a limit order book. Matches in bid and ask price value go through as successful trades and are eliminated from the limit order book. Various trader types are included to populate the exchange. The OZIC trader is one of them. The OZIC trader model comes from the Goad and Sunder 1993 paper. They compared the allocative efficiency of humans and ZI trader models and found that zero intelligence constrained trader models perform similarly to human traders in terms of allocative efficiency. Zero intelligence means that they have no knowledge other than the minimum and maximum transactions in the market session. A zero intelligence trader will submit bid and ask prices randomly from a uniform distribution between those minimum and maximum prices. The OZIC trader has a constraint, which is a limit price that they cannot exceed if they are a buyer and cannot go under if they are a seller. In the diagram on the right, we show in blue the uniform distribution the zero intelligence constrained traders draw from. Opinions, as defined in the opinion dynamics models, are represented by real numbers from -1 to 1. In other words, the extremes of the opinions have embodied political opinions, i.e. far left and far right. However, in this work, we say that they can represent the trader's opinion on the true value of the stock. For instance, -1 is a negative opinion, and +1 is a positive opinion. The aim of an opinionated OZIC trader would be to submit high quote prices when they hold a positive opinion, and vice versa to submit low quote prices when they hold a negative opinion. We have captured this idea by introducing an opinionated limit to the OZIC trader, which is proportional to the opinion that the trader holds. If the opinion is negative, the buyer submits prices close to the minimum, and the sellers accept bids from a larger interval, i.e. from their limit price to the maximum price. Then, if the opinion is positive, the buyers submit from a larger range, i.e. the minimum to the limit, and the sellers accept only high bids close to the maximum. Illustrated by 3D plots are the simulated opinion distributions. The height of the 3D plots represent the number of trading agents that hold an opinion. The opinion from -1 to 1 is shown on the left width of the plots, and time is represented on the right depth of the plots, going inwards. Shown in this slide are the results for 2 market sessions with extreme positive and extreme negative consensus. The extreme opinions here are created using the relative agreement model with a group of extremists skewing the population. Here we show an extreme shift from positive to negative and negative to positive using the relative disagreement model. A moderately sized population of extremists is required to shift consensus completely. This model successfully creates traders that bid and sell high when they have positive opinions and low when they hold negative opinions. However, it fails to capture the trend shown in real market data. We want a model that simulates upward trends and downward trends depending on the opinions. Using the trader model definition from the paper, Asset Price Bubbles and Crashes with Near Zero Intelligence Traders, we use the same logic to build an opinionated version of the Near Zero Intelligence Trader. Shown in the left side graph are the results from the paper, Asset Price Bubbles and Crashes with Near Zero Intelligence Traders. Market sessions or periods are represented on the x-axis, and the price of the traded stock is represented on the y-axis. The purple, green, and blue lines show simulated market data which increase in price in the first 7 periods of trading, then plateau and crash towards the second half of trading. The jagged red line shows actual data of an asset bubble that they use to optimize their parameters in order to resemble realistic data. The bottom black line across the graph is the decreasing default value, and the top black line is the expected value of the randomness variable that is drawn from a range proportional to the default value. The Near Zero Intelligence Trader simulates asset price bubbles as shown in the left graph. The trader has knowledge of the previous mean transaction price, PT-1, and the decreasing default value of the stock, DT. Firstly, the trader calculates a randomness variable, UI, between 0 and kdt, where k is a constant parameter. A trader that is a seller will offer an ask price, AI, calculated by 1 minus alpha times the randomness variable plus alpha times the previous mean transaction price. The buyer then offers similarly, but with a budget constraint that they cannot exceed the money that they have, XI. Another way of visualizing the calculations is that the near-zero intelligence traders randomly draw from a range alpha pt-1 and 1 minus alpha k dt plus alpha pt-1. These are the minimum and maximum ask prices since the randomness variable UITS is drawn from a range between 0 and k dt. Similarly to the OZIC traders, an opinionated limit is created between the ranges, where buyers can offer bids between the minimum and the opinionated limit, and the sellers can offer asks between the maximum and the opinionated limit. Here we show the extreme convergence results. On the right, in green, is the near-zero intelligence trader data, and in orange are the extremely positive and negative opinionated near-zero intelligence traders. Then, using the same relative disagreement model extreme shifts used for the OZIC trader results, we simulate market sessions where after the 7th period of trading, the opinion shifts from positive to negative on the left and negative to positive on the right. Here we can see the price going up and down. At this point, I have described the opinion dynamics models and 2 opinionated trader models in our simulation tool, but I haven't really explained what the tool is good for. In Nobel laureate Robert Shiller's 2019 book on narrative economics, he described the importance of narratives on major economic trends, such as cryptocurrency. Shiller proposes using an epidemic model, Cormack-McKendrick's SIR model, to describe narratives as diseases that spread from infectives to susceptibles, to be eventually forgotten by recovering from the disease/narrative. Our approach using the opinion dynamics models can be adapted to model opinions this way by simply having a probability that extreme opinions transfer to another agent, but we believe that by modeling using degree of opinion will provide more realistic simulations of market data. So the first application of our tool is to explore the ideas described in Shiller's work. A second application of our tool is to simulate fraud, like pump and dump for fraud detectors. In pump and dump, small groups on online social media forums like Twitter and Telegram, organize pumps of stock only to sell quickly, hence sending the value crashing. The relative agreement and relative disagreement models have been used in the past to model how extremists form on social media networks, and so could be applied to modeling pump and dump behavior. Cryptocurrency markets are unregulated, so these forums are open and we can see direct correlation between the messages and the pumps, which gives us a good way to compare our work against real fraud data. A few ideas for future work on this project would be to simulate recoveries described by Shiller in his 2019 book, variable buyer and seller sizes to more closely resemble the results in the near-zero intelligence model as described in the original paper, an asymmetric confidence factor between agents using the bounded confidence model to provide more interesting results, a graph network to replace random communication between agents to simulate social media networks. Finally, the near-zero intelligence trader models have knowledge of the default value and the previous transaction price. It might be worth investigating opinionated traders that use their knowledge of previous rounds of trading to shape their opinions using well-known patterns, such as cup and handle. Thank you for your time. My name is Kenneth Lomas, and this has been Exploring Narrative Economics, Integrating Near-Zero Intelligence Trader Agents with Opinion Dynamics Models by Kenneth Lomas and Dave Cliff.